Welcome to the call. You are at Investment Hacking Live with Joshua Dudgeon. This is reir.co is the website to look me up on. And you can also look up at the long URL, realestateinvestmentresults.com. And we're going to start by reading a disclaimer. And that disclaimer should be up shortly. Here we go. Investment Hacking Live and Real Estate Investment Results. Disclaimer reads, Real Estate Investment Results, its officers or members provide no legal or professional advice. You should always consult a licensed professional, a professional appraisal, a real estate agent, or a financial advisor when making any decision regarding the purchase and sale of real estate. The information obtained from reir.co, Real Estate Investment Results, and or its members is intended solely as general guidance, and exchanging or buying or investing in real estate and does not constitute legal, financial, tax appraisal, accounting, or other professional advice. Because real estate contracts, closing procedures, and disclosures are guided by state law, always consult a local professional whenever engaging in a real estate transaction. All right, with that, we'll get started on my PowerPoint. So I'm going to share my screen, and then we're going to go and hit start screen. So the topic today is how to find land deals. And land deals are generally deals where a raw piece of land is going to be converted to a end use property. It's happening all over the United States right now because there's such a shortage of real estate, as I mentioned before. But the difficulty is how to find and figure out the value of the property. Generally, these properties that are going to be valuable are going to be in what they call the path of progress. So what that means is a town is expanding in the direction that that town is expanding in. That real estate is the real estate that you're looking for to get at a one price, convert the use, and then resell it at a much higher price. Many of these deals have a 10x factor, meaning it's bought at a $300,000 price point and it's worth $3 million or more when the uses are changed. And it's basically a measure of getting the documentation, the paperwork through the system to get it to the end use stage and then start selling it off either per unit, or sometimes builders will build the entire product or buy the entire product so they can build it out. When I say in an area that is expanding, the area sometimes, like in Florida, it's expanding all over. So you can have more than one area expanding together. One of the models that an investor years and years ago had, and I don't think you can do this anymore because Walmart doesn't actually post this, but there's an investor I was in a group with probably 10 years ago, and she would follow the Walmart's map. Wherever Walmart was going to put a new Walmart, she was buying up land around that area. And it was very easy because once Walmart came in, the value of that land went up and she was able to make quite a hefty profit. So the thing we're going to look at first and talk about first is the value of the end use lots. As in all real estate deals, you got to begin with the end in mind. You make your money when you buy, you realize the profit when you sell. So if you don't buy right, you cannot make a profit. And so that's where we're going to start today. So first, you got to figure out how much is usable. So you find a piece of property, and the biggest thing that is necessary is how much of that property is usable. I'm going to give a case. I'm going to actually show you a property that where to find it and a website you can find stuff on, and then it'll show you the actual numbers at the end of this. But as you look at a piece of land, many times, let's say it's like 100 acres, there's a percentage of it that will not be usable based on topography. Wetlands are number one. So if there's like a stream, a creek, a swamp, that wetland is acres that cannot be used. There'll be utility easements sometimes, which means like there'll be a main power line going through. A lot of times that power line, you can't put residential underneath it because of the risk to the family's health. A lot of times underneath it, you can do certain things, but you can put like a road in, or you can do some type of landscaping there. But the fact that it's an easement means that they have to be able to access that space for the power line. So if there's a utility easement across the property, that area sometimes gets lost as a value to convert to make the land more valuable. Easements in general, so let's say you buy a piece of property and there's a landlocked piece of property next to it, so that person has an easement to cross that property. If you fight over that situation and there's already an easement in place, a lot of times you'll actually end up losing more value, because if they have to force a road, a physical road in, versus someone just crossing it for use, a lot of times that road is much bigger than what they'd be using if they were just crossing it. So easements in general can have a problem. And then topography in general. So like if you're dealing with a piece of property that's really hilly, a lot of times based on how steep the hill is, it may be unbuildable in certain areas. And so if you have raw land, that is some of the best deals for speed are raw land deals where the land deal is actually flat and has very little topographical issues, wetland, utility easement, topography, or easements in general. So you want to be looking at those things, and we're going to show you the percentages and the things you got to look at of how to look at this end use value. These are the biggest ones to find out how much is usable. Next, once you find out how much usable, there is a loss based on loss of use based on having to put the utilities and the roads in. In general, rule of thumb is once you figure out like there is X number of acres usable, then you end up losing about 20% of the land to roads and utilities. So you're trying to figure what the value at the end is. So if there's 100 acres that's usable, 20% that is necessary for roads and utilities for the people that are going to be moving into those lots represents 20%. So you'd only have 80% acres for usable. And then you got to determine whether the local municipality is going to allow you to put two lots on an acre, 4 lots on an acre, or it would even go to a higher per acre usage, which that's where multifamily comes in. And then also we're going to cover the types of uses that change too. So in this scenario, 100 usable acres, you lose 20% of it to the roads and the utilities. So you'd have, and if you have 2 lots per acre, you'd have 160 lots for sale. If you had 4 lots per acre, you'd have 320 lots for sale. And so a lot of times when you're talking about 100 acres, there would be 3 phases going to happen on that. So you'd be building out a third of those, and then once those would sell out, you build out the other 2 phases. A lot of I'm just using 100 for round number. A lot of these deals are as small as like 12 to 25 acres, and those ones are usually 1 phase and they sell very quickly. But the quantity of land isn't as important as the value tied to what is usable via topography, and then what you would lose in your usable land because of your necessary roads and utilities. So there's 2 types of lots in residential. We're going to talk about different types of lots, but there's 2 types of lots in residential. There's a finished lot, and that has water, city water and sewer. So if you're next to a municipality, a lot of times these land deals are saying city water and sewer to the lot line. That doesn't mean there's city water and sewer on the raw land, but it's right there. And in some cases, that city water and sewer will have grants, or depending on the demand in the city for lots, the city sometimes will even help pay for getting the city water and sewer closer to or onto the property. A lot of times it's part of the cost of building them out. And a rough or unfinished lot generally has well and septic demand. Sometimes you can have a well demand without a septic, or sometimes you can have a septic demand without a well. So these rough lot just means you're missing those city water and city sewer. And so roughly on rule of thumb, a rough or unfinished lot is worth about half of a finished lot, because of the fact that those well and septics have to be paid for by the end user. So it represents about half the lot value. And really when you put those horizontals in, many times the cost of horizontals is half of the lot as well. So when you're trying to figure out what the value of these lots are, you want to be paying attention to what the comp lots are selling for. So if it's a rough lot and or unfinished lot and it's selling against a finished lot, the finished lot is worth more. And so a lot of times if the number is X on a rough lot, it can be worth twice as much if it's a finished lot. But then a lot of times, depending on the area, if you're comping against a rough or unfinished lot, what you're going to end up putting in is a rough or unfinished lot as well. So just pay attention to the difference between those two. If all the sold lots in the area are unfinished, then that is the lot value. So you don't have to discount the lot if all the lots that you're comping against have a demand of well and septic on each lot, then that is your price for your unfinished lot. And then often because of the supply of local municipalities will then bend over backwards to help you get through your project. So knowing what your demands are in the area, the municipality, is one of the best ways to figure out what you're going to do with the project as far as the land, what the end use of the land. So if you're sitting on a piece of land that's in an industrial area, it's going to be more of an industrial sub that you're going to be putting in on that. So here's the type of land conversion. First is single family residence. The single family residence is basically, a lot of times this includes duplexes because it can be sold off as single family residence as well. But generally it's a single house on a single lot. Then there's multi-family residence, and that is either duplex, fourplex, or higher than that. Sometimes those will even, really, like if you go to an older part of the city that's booming, let's say downtown Atlanta, a lot of times that high density residences, you're still going to sell those off as single family residences, but it's a big building with like 100 units in it. That is considered a high density residence. Then there's commercial. Commercial is like a strip mall or office building. Then there's commercial mix. Commercial mix is what's happening a lot of places now, especially in older towns. Commercial on the main floor, residential on the second, third, fourth floor. So that's a mix, and there'll be a density ratio. Many times in those buildings, there has to be underground parking for the residences because the street parking is for the commercial space. Then there's light industrial. Light industrial is going to be an area where you'd have kind of a mix of factories / commercial. So there may be office space in there. There may be warehouse space in there. A lot of business condos would be in a light industrial. And then there's industrial. And industrial is where there's like a big factory going in. These big Amazon warehouses, those are generally going into an industrial area because they're taking up so much land and no one wants to be living next door to the Amazon. So that's more of an industrial use. And the industrial uses will change over time. We'll do different trainings later on about different other types of commercial projects, because there's a whole bunch of commercial project types, but these are the land conversion types that you need to look at. Now, every single area you go into, they're going to have a local code name for these types. A lot of times single family residence will be referred to as SFR. There'll be differences in what they call multifamily, high density, and you need to be talking to the broker that you're going to be talking about the project with about what their local code means. So you can see multifamily in one area could mean a duplex that you can sell off as a condo, or it could mean nothing less than a fourplex, or it could be even higher than that. So the high density residence is generally higher than a fourplex, but it changes from local area to local area. Commercial, light industrial, industrial are very similar, usually in every area. Those are named the same thing, but there will be different phraseology from municipality to municipality of what they're asking for here. And then here's another concept. Took me years because I'm kind of a hard-headed person, but it took me years to figure out that it's best to do what the local municipality is looking for. So if the area is short on single-family residences and you're trying to put a high-density project together, you're going to get more resistance from the local municipality, meaning most of the stuff has to be passed through boards. So when you try to give them what they don't want, it becomes difficult. And a lot of land deals get held up because of all the hoops you got to jump through. So the best thing to do is actually go to the local area and say, what does the local board need in this market, and they'll tell you. And then that's what you're going to try to use the land for. So sometimes you could be looking at a piece of land that you thought was going to work for a single family residence, but the local municipality says, hey, we have not enough multifamily or high density. So we would prefer it being multifamily high density. That is what you start to look at that project as a high density residence multifamily, and vice versa. Because they will, a lot of times, because of where we're at, there's so much demand that they will bend over backwards to help you get your project where you need to go. All right, so I want to go over, this is a little calculator I put together just so I can evaluate property quickly. Right here is your original ask of the property. This is the number of acres that are available, and this is for a 4 lots per acre scenario. So you're paying $12,583 an acre for this number of acres. And that means with 4 lots per acre, you're going to get 215 lots. So your actual price per lot is $3,932. Generally speaking, depending upon the end use price, if you're under $10,000 on this price point, you're doing very well. But there's going to be other limits that I'm going to show you later on. And then over here, you have horizontal infrastructure costs, because that's part of it. So we got road costs, road sewer costs, sewer and electric. These are just ballpark figures on most projects. A lot of times, if it's going to be the roads or the sewer and electric, are like if it's going to be a unfinished lot, the sewer and electric won't count. So then you just got to figure the road costs. I'm using just $1 million because it just seems like every horizontal infrastructure I look at is somewhere between $600 and $2 million. So I'm using $1 million as a round number. That's factored in over here. And then this is where the lot resale value is. $75,000 is what I got in here. There are places in Florida and other places where the lot value is $150,000. That makes a big difference. So the big changes that you're going to see here are the number of lots, because you got 4 lots per acre. And this is accounting for the loss of the 20% for roads as well. And then the price here. So if this gets cut in half, then this gets cut in half. You're going to see that on the next slide. And then if this gets doubled, then this is what this part right here. If this gets doubled, then it looks like this number again. But on this project, there is a total value of the project sale price of $16 million. When you take the $1 million in roads and you take the cost of the land originally out of it, you end up with $14,325,600 in projected profit. Now, this is really raw, rough numbers, but it gives you a baseline to be able to look and talk intelligently about a land deal so you can make offers off of. I'm going to show you the difference when it goes to 2 lots. So the next slide is 2 lots per, and there are areas where you need 5 acres for a lot. So you got to pay attention to that, how many houses you can put on that area. Because if this went to 5 acres per lot, now it's shrinking the number of lots way down. So you got 107 lots available here. And instead of it being worth that 13 million that was before, it's now worth about 6.2 because the horizontal infrastructure didn't change. All right, let's go over and look at the places you can look. So one of the best places to look is a website called Loopnet. There's a lot of websites out there. This is really the national standard for commercial looking deals. Those numbers that I just had up on the screen are off of this actual project. This project is in Florida, Punta Gorda, Florida, which is the West Coast, Tampa area. And so in this listing, they're going to show you picture. This is a picture of what's out front. This is where the property is. This is where the airport is. Most of the real estate's right up in here. So this is kind of an area on the outskirts of. Now you're paying $13,000 an acre. He has there. The executive summary is where you're going to get some of the detail, but much of the detail you're going to need, you're going to have to call and ask for because they're not going to have the detail. But here you have commercial property. Southwest Florida is pleased to present 67.39 acres of vacant commercial land. The property is close to Punta Gorda Airport in downtown with direct frontage on the major corridor. Oh, that's one of the things I skipped over. The amount of front.
Josh, you need to reshare the different screen.
Oh, okay.
It's still showing the PowerPoint.
Okay. reshare. That's not on the reshare. New share. There we go. I got it. New share is what it said. All right. Boom. You there? Can you see it?
Yep, that's good.
Okay. All right. So here we are. I read through this portion right here. Much of the detail is going to be, you're going to have to call and ask about. So it talks about road frontage here. One of the things that's valuable is it says direct frontage on the maze recorder. A lot of times it'll give you the amount of feet that are in that direct frontage. The value of that direct frontage is some of these subdivisions will be residential, but the front of it will be commercial or light commercial. And that road frontage matters because that's where people are driving by and can see. So if you're going to put a strip mall in or something like that, you're going to need road frontage for them to, for people to see the business. So that road frontage value will then create more value. By the way, when you went through those lists, industrial is generally the most value per acre. Backing up through that list, all the way back to single family residence is usually the lightest, but single family residences, because of the shortage of housing right now, are the fastest convertible lands to zoning and then to sale. So many times on like an industrial project, the time to sell out that industrial project can be 20 to 30 years. But if the first 2 or 3 lots pay for the whole project, it really doesn't matter to you because you're going to be making profit year after year on those deals later on. But the fastest selling is usually the least valuable per acre at the end. All right, so road frontage can be, you can have a piece of property that most of it's going to be single family residence, but the front 10 acres or whatever it is going to be commercial or light commercial residential mix. And you need road frontage for that to happen. So whenever you see road frontage, that's a good thing to be looking at. All right, so here you have, this is the website, loopnet.com. Here's the address. I'm just pulling up this one. There's the contact information. There's a flyer here that you can go look at, and it'll have usually a little bit more information. Sometimes it's got the same. So here we have close to Punta Gorda Airport, and then Tuolumne Trail. It's giving you the traffic volume. Like a lot of times that'll be important to know, like, because you can go look at different like companies that are going to put commercial in, let's say like a fast food restaurant or a gym. They're going to have a demand of how much traffic volume they want. And so that's why these traffic volume numbers matter. The population in 1 mile matters because the more population is in the area, the more people will add or be able to shop there or use a gym. And then this median household income, that's a big deal as well. Because in general, if this is down to like $50,000, at $50,000, most of the houses are going to be under $200,000. And just as a builder and all the supply chain issues and the cost variances that have happened since COVID, right now to build out a brand new house, even if it's a duplex and you're selling half of it, you need to be in the $300,000 price point. So if someone is making $130,000 a year, it's easy. You know that person can afford to buy a $300,000 to $400,000 single family. If they're making $50,000 a year, it's a lot harder to sell anything that's over $200,000 because generally there's 2 incomes, so they're going to be 250, so you'd be at 100,000. So if there's a single family or a median household income of over 130,000, that is a good sign for the area. But we're still going to look at comps. This is generally the flyer. If you want to go look at the flyer, that's usually attached right to the property. Let's see if I can get out of this now. Close that baby out. There it is. All right, so here we go. We're back on the main page. Now, you can go pull in, you can go scroll in on that. Usually the map is attached. A lot of times this will be in the wrong spot. This one happens to be in the right spot. But if you pull out, you can see this is Fort Myers area, Cape Coral. It's just north of here. And by the way, basically from here to clear up by here is just booming. Lee's Villages is right here. That's booming. The Jacksonville area, you can't even, I found a land deal when I was down in Jacksonville a month or 2 ago. It was gone like weeks. This area, the average lot price in this area, just from study, is about 150,000, which that lot value matters for what you can get accomplished. But yeah, Florida is booming right now. Basically, New York City is moving to Florida really quickly. So this area, I'm going to scroll all the way in on this, so you can look at it here, and then you can go to and hit the aerial map. Now you're going to be able to see what's going on. So you can see here you have subdivisions, and you can see density here. How close the houses are together. These are not as dense as many places in Florida. Matter of fact, let's go closer to the ocean here. This is very common as well. So all these people have in their backyard access to get out of the ocean with a boat because they built all these channels. But see how the density here? This right here is about 4 to 5 units per acre. It might even be a little higher than that. The density here is pretty intense, which is good. It makes the land more valuable if you can get that 4 units per acre. But we're going to go back here. So this is kind of, you notice this is in the path of progress, but it's further away. And when you can still use comps, you can still see that this will be a future area of where lots can be sold. And I'm going to show you how to look for the value now. The site that's easiest to use is Zillow. Some of you over here, we're in basically the same spot. Matter of fact, I had Punta Florida in here, and these are sold. Zillow's a pretty easy site to use. They're a little behind the times, but it still gives you a good average. They try to update quickly, but a lot of times you'll find that they're a little slow. But it's still a good average. So I've got this sorted for right now. I've got to sort for lots, and I'm asking for every lot that's 75,000 and up. You can take this back to 0, and you're going to get a lot more lots, right? There's going to be, see these $6,000 lots in here. A lot of these, some of this gets messy because you don't really have a high, to look through these, you might find that they're doubles or they're, Zillow is a mess, but it still gives you a baseline to look at. So let's go back and put that 75, because you want to look for like a $75,000 baseline. And if you don't get the 75,000, then you'd have to back out to 50. A $50,000 lot is kind of gone by the wayside. Okay. So right now I got it set at 75,000 as a base, and you're seeing there's quite a few lots in here that have sold for over 75,000. That is a good sign. The other way to look at it is to look at it from you can change this lots over to houses. And now you want, because new builds, like I told you, 300,000 is pretty much the bottom for a new build. Now different areas it can be a little higher or lower, but you won't see it around 150,000 to build something new anymore anywhere in the country. So here's the $300,000 house point. You're seeing that there is one that's sold there. Matter of fact, as you scroll in, they get better over here. So if you look, these, that's an older house, that's a newer house. These are built in like the 90s or 2000s. So you can see that they're still selling for a good price, $375. So anything that'd be new comping against this, that's an older house that's been remodeled. This one's a little newer. These are brand new right here. So the brand new ones, the cheapest ones, look at it, 3 bedrooms, 2 baths, 1,500, probably slab on, it is slab on grade. So you got 1,500 square feet, selling for $305. That's just a starter bread and butter house right there. Let's see where it's at 305. Yeah, it's probably right here. Yeah. Yeah, that's it. So that was a subdivision that was probably built before, and these are lots being used up. Now let's go look at it from a different way. First, let's go look at it from change the sold to for sale. All right. Lot less property available than what was sold. But look at where the price points are as well. Let's take this down to 200 and this up to 300 max. See how there's hardly anything available in that price point? Now watch this. Let's go down to 100, 200. Still some at the 175 price point, but look at the age on 50s, probably even earlier, some are probably, a lot of these are gonna be post World War II, so 45s, 50s, but very few of them. And then let's see if we can find what the lot size, 864 square feet. Look at that. 132,000. That's what it buys you. It's crazy. Doesn't say lot size on here. Because a lot of times these lots, if they're older, will be still good sized. So like if the lot price in a market is 150,000, this house can be bought, tore down, and built up. If the lot's big enough, it's a value just to tear the house down. It doesn't happen as much as new lots, but you'll see that there's hardly anything left for the 200,000 or 100,000 to 200,000 price point. So let's go back and clear this one to go to 700. We just go to 0. No minimum, any price. There we go. All right, and let's go put this price back up here. Let's go take this to 500,000. So even at 500,000, you're seeing there are homes that are for sale at the 500. Let's see what it says for sold at 500,000. Yeah, quite a few. If you notice, they're kind of grouped. A lot of times that's the area that those prices are in that area, but you're seeing a huge amount of $500,000 sold over here. These generally are supposed to show up in the last year. So if you click on any one of them, it's going to tell you when the sold date was. Sold on 5/24/21. So this market is booming. This is all the stuff that's sold, and it's, if you notice, it's a lot of it's in 500,000 around. So why 500,000? 500,000 represents the value of the resale value. So that represents the value of what a new house can be sold at as a baseline. And we're going to go back and look at the spreadsheet in a minute. But when you look at this, now we're back to this area again. So let's go back over here. This is the exact same map for where this spot is. And if you look, so this, where Zillow is at, that piece of land is somewhere right in this area. So we have somewhere right in this area. So we have, there's a good potential of since you have all these comps, you know that if this was turned into a subdivision, you're gonna be able to figure out what those lots would be worth. And now that we know the density is pretty high in here, it's somewhere between 2 and 4, and it might even be 5. It's easy for you to get that density. Now I want to look at one more thing before we go back. Let's take this back to 100,000. Actually, let's take it back to 75 again. All right, and then we're going to take this back to lots. And then we're going to take it back to lots. So this is the lots that sold for 75,000 and up. Right. And see, the problem with Zillow is like this 312,000, right? Let's go to that. This likely was a house that sold, but Zillow can't tell you that because the buyer that bought it when it was a lot, with the builder putting the lot on it. He didn't pay 312,000 for this house. So that's where Zillow gets goofy. So just learning some of this and understanding it. He bought the house and a lot, and then Zillow's got it that he just bought the lot for 312. So some of this you got to take with a grain of salt and understand what real values are. Whereas this lot likely sold for 125,000. And the reason I would show the difference is because one guy is buying a lot and going to build it himself in his own general. The other guy is going to a builder. And in Florida, many times you can't find people to work unless you're going through the builder. And so you put your money down and you wait for the builder to get to your project. But what I want to look at here before we leave is change this lot price to for sale, because this is going to be interesting. Look at how many dots are as compared to how many were sold. Again, let's look at that. This is a 4-acre lot. This is 4 lots. See that? This is actually a really good comp. So this guy is selling 4 lots at once. So it's 1.1 million. That means he is if you want to get a piece of property with some water close to you and have a huge lot to build on, you're going to pay 1.1 million. So it's over 250,000 per lot there, 4 acres for 1.1 million. That's a good comp to look for. When you get down next to the water, especially in Jacksonville area, it gets crazy. But let's go back to this area. So see how there isn't a lot of lots available in this area. You'd be wanting to look at this one here. 400,000, doesn't say how many square feet. What about these over here? 305,000, that's 21 acres, that's a huge lot. 170,000, it's a 4-acre lot. Where's the last subdivision lots that those sold? So we got subdivision lots here. Oh, that didn't work. 0.59 acres of lot there. 0.59 acres of lot that sold for 95,000. So 75,000 is a very conservative number to be using. And as a baseline, now we're going to go back to the PowerPoint. So here we are in the PowerPoint, and this is that same number. So it's 848,000 for the thing, for the whole land. There's 67 acres there. If we can get 4 acres a lot, it's $215,000. Sorry, 215 lots. And the lot resale value at 75. This project would legitimately be worth, at the 4-acre lot price, 14 million finished. Now, I believe the horizontal infrastructure number's off. So, but even if it's $2 million, instead of it being worth 14 million, it's now worth 13 million. And you're paying 848,000. So let's say you got 840. So you're basically going to be at $2.83 million to get a $12-13 million return, which means you're quadrupling your money. Land deals are very impressive. They are harder to do, but let's go back to some of these other conversations. I missed covering. This is the 2-lot price, and then that's the 4-lot price. All I did on this spreadsheet, I'll pull up that right now. I just built a little spreadsheet out that puts all these different variables in. So you can change this. So if we change this to 2 million over here, keyboard. See how it adjusts the price, and then we change this number to a 4. That's 4 lots per. So this is total number of acres times 0.8. That gives you the road removing times 4 lots per acre. Now at 75, now it's at 13 million. If we're wrong, so we saw all the lot values higher than this 75,000, but it is further away from the river, so that's why I'm using a more conservative number. If this goes to 150,000, if it's real to go to 150,000 on this, oops, that was 1.5. It's look at the difference. Now you're at a $29 million project. Land deals are very lucrative. Very exciting. So let's go back and just talk about one more thing on the PowerPoint, and then we'll open it up for questions. So we're looking at the types of land where we mostly cover single family residence because that's the highest demand right now. There can be some light commercial in there if there's road frontage, like I said. So that piece will be cut off. You can still evaluate based on all single family residence because everything that's above single family residence is going to be worth more per acre than the single family residence. So basing your end use value, we need to share, change the share. I think we're the same. Basically, if you figure on single family residence, even if it's going to be industrial, it can give you, if you can't figure the industrial number, it's best to just use a single family number because that'll be the lowest value. And then you would utilize that as your baseline to justify whether you want to start into looking deeper into that project. But let's talk about the biggest issue of why these values, why you can triple your money. most people don't know how to do this conversion from raw land to actually turning it into a usable property. And when you talk about how to get to that next level, the best thing to do is get some training on it, like I've done, and then start to really look at these different areas and how to evaluate the property. Because generally, if you get close to what you're trying to find and find a property, especially if something's in your backyard and you're like wondering about what's the real value, these rules of thumbs matter. And then we're going to talk about one more thing before we go to questions, and that is based on that lot price. How do you figure that lot price as a percentage of the because I showed you how to look at not only the lot price sales, but let's say you can't find very many lots in an area and you want to go off of the sale price of the house. So if you know that a house is selling for $400,000, the cost of the lot in general for the building is somewhere between 10 and 20%, and you can use 20% as a rounding number. So on $400,000, if you take that times 20%, you get 80 grand. That's why I told you earlier, 75 grand for a lot is pretty much a baseline, because it takes $300,000 to $400,000 to get a new house, and 20% of that is 80 grand. So in general, the cost of the things have gone up, and in general, the 20% mark means that most new lots that are going to be built are going to be a minimum of 75,000. Now you get to an area where it's $500,000, $600,000, $700,000 finished value. Now that lot cost can go up, because that's where you get to that 150,000 lot price, because the back end represents about 20%. So that 20% of end use matters. So let's say you're comping against, you're not going to put city road and sewer in. It's going to be it's going to need sewer. It's going to need well. So you're going to have an unfinished lot, but all the comps are on finished lot price. So what you do on that situation, when you say, okay, it's 150,000 is the lot price for a finished lot, you would back it down by half if they're going to have to put their own water and sewer in. In general, you're not going to have this problem, because in general, if the area is water and sewer necessary, then your comps are going to be water and sewer necessary. And the other thing that has just happened in the last 2 years, because I was, as a builder, I did a lot of this. I went and bought up the end of a bunch of subdivisions that have been sitting since 2008. So I'm paying 40, 50, 60,000 for lots. But if that subdivision was built right now, they need $75,000 a lot, because I'm cleaning up old subdivision, which the guy's already paid for the whole sub. It's just money waiting for him to get to these last lots. And so if you're in an area that's just starting to take off, and they're older lots that are selling for 50 to 60,000, and you're about to build out new subdivision, your new subdivision lots may be worth more based on the fact that they're brand new. Again, there's a lot of variables here. I will do more training on this later on. With that, hopefully that was very easy to understand. And if not, you can ask all the questions you want. So go ahead, Brady, and get us any questions that anybody has.
Can you negotiate on land deals, or what would that process look like?
Yes, so that's a whole nother training, but it is negotiable. In these hot areas, it's really not, because so what you really want to do is on Loopnet, you want to be looking, and I didn't even go into detail how to search on Loopnet, but it's get on Loopnet and start playing. There's other places to look, but so on Loopnet, the age of the listing matters. So if it's been on the market since 2014, that's one that's more likely to be negotiable. They will say in the listing a lot of times, bring all offers. One of the most important things to be looking for if you're going to negotiate is, will the seller hold paper? It'll say seller will participate, meaning you don't have to pay them off. You give them a down payment of less than $100,000 in many cases, and then you go and get the conversion done, and then you go resell, and then so this is a whole other aspect of the training. But in reality, the value of getting the numbers right, so you know what you're looking at, is what we're trying to get to today. If the area is hot, you won't have time to negotiate. The way land deals are done, you don't write an offer, you write what's called an LOI. And I can go in a little detail on that It's a letter of intent. It literally is usually the best ones are 1 to 2 pages. If you let an attorney do it, it'll be 30 pages. That screws it up. The simpler the LOI, the better, because you want the seller, who's a lot of times an old guy, who either inherited land or is going to give his land away, and he just wants to know what are the numbers, and giving him a simple LOI matters. After you submit an LOI, the LOI is signed by both parties, and there's usually 60 days of which money changes hands to get it to start. And then in 60 days, you have to have it under contract to close, or be heading to closing. And there's usually like due diligence you can figure out in that 60 days. So let's say it's a hot piece of property, you can put it under contract with an LOI. Technically it's not under contract, it's a letter of intent. The reason you don't want to use a purchase and sale agreement, that I just learned from experience, is because the purchase and sale agreement literally makes a legal binding arrangement that if the guy goes away, the seller can't unhook from. So the LOI is, we're showing intent here, and everybody's just walking down a path, hopefully gonna get to a close. The thing about LOIs is, and this is where sellers are like, they'll say, I don't want an LOI, I want an offer to purchase. That's because most of these deals you'll find a lot of problems in them. So they'll have tried to sell it 3 or 4 times, and the LOI held them up for 60 to 90 days, and then it went away. And then they waited 6 more months to get another one. So if the seller has tried to sell and had 3 or 4 people walk from the deal, they're either asking too much, or there's something wrong with the property that's keeping it from actually doing it. By the way, a lot of times there's something wrong with the property. Like there was one that was in my group, and it was like a $300,000. Matter of fact, I actually either turned the deal in or was going to turn the deal in, but I had my other deal going, and a friend of mine turned it in. A guy that was in the group, they pulled the trigger on this deal, and all they had to do was convert. The land was tied up in some farm, had to be farmland ruled by the government. It couldn't be built on for another 5 years. And the only way to make the subdivision work was that had to go away. By the way, the seller paid the penalty, and we as in the group just converted it to being able to build. As soon as that thing went away, the price of that land was worth 5 times as much. So all these other local guys were looking at it going, hey, I want to do this into a sub. It was a great place to do a sub. They couldn't get the subdivision to happen because every time they looked at it, oh, it can't be built out for 5 years. But it was just, all it was a nuance. You had to figure out how to change that. Once that got changed, so it justified the price. That deal is actually, all they're doing is changing that paperwork, and a builder is likely going to buy that whole deal out. I think they paid like $300,000 or $400,000 for it, and they're going to probably sell it for 1.5 to $2 million, and they just changed paperwork. So some of these deals, you're not even going all the way to the end use. You're just getting it prepped so that a builder will come in and buy it, especially in a hot area. They'll either buy half of it, which covers all your costs, and you can hold the lots, which is a good idea because the end of the lots are always worth more than the beginning. So as a subdivision fills out, the prices of individual lots are higher. But a lot of times the builder will be coming in and buying the whole thing. On the deal we did in Gibson, Michigan, it was matter of fact, maybe I'll go into more detail on this later on. It was a pre-lotted commercial strip of land. It was next to a prison, so there's no way it could be a residential because it was right next to a prison. But Gibson Landing is southeast of Ann Arbor. Ann Arbor is like the Snob Hill of Michigan, Detroit, Michigan area. A couple other nice areas, but Ann Arbor is one of them. There's not hardly any land left for commercial. There are some commercial lots, but you can't find that much in Ann Arbor anymore. Ann Arbor's commercial lots were 500,000. Everything is less, for 500,000 for either an acre and a half. Our lots were like an acre and a half, and so we easily had them appraised at like 250 to 300,000 a lot because they were discounted from Ann Arbor's. So just remember these percentages that are having half of what Ann Arbor's worth. Ours were surely worth. We had to get the road in though. So the road originally was going to cost $500,000, and then COVID hit right when we bought it. So it was impossible to get the road in. Plus the cost of the road went to close to $1 million. And so we paid $139,000 for the land. We had it assessed when the road was in, it was going to be worth $3.4 million. So we're going to be in around $1 million to make 2.4 profit. Because COVID stopped us, we couldn't even physically get a road in. We ended up just putting it back on the market. And all we did was double the money to $300,000. So even stumbling forward, buying the right deal, we stumbled forward, still double the money. And then the new guy, because right at the end of COVID, so we bought it right at the beginning of COVID, and a year later we sold it. And when we sold it, it was immediately doubling our money, even when we failed. So these land deals are a really big deal. Any other questions?
Internal access routes, fire roads, trails, or pathways, does the property owner have to disclose that, or is that public knowledge?
You talking about say that again, read the internal what?
So internal access routes such as fire roads, trails, or pathways, would the owner have to inform you of those, or would those be
generally they will let you, because that's those easements. Generally, those are going to be on public record. But that is what that due diligence period is. You were to find all those things. Because if you buy it with something that you didn't find, you own it. The commercial world is once you own it, you own it. There's very little recourse. There will be people out there that are trying to trick. So that's why that due diligence pays. So let's say you come across a piece of property, and the guy's like, I don't want an LOI. I only want an offer to purchase, and we're going to go close because I've already had 3 deals fall out. There's a reason those 3 deals are falling out. Figuring that out is what you need to do. And then if it's very easy because somebody just didn't know how to do that, fix that, then you figure out if it's fixable. If it's not, go walk away from the property. Just do not do it. Because you will own that problem even if they're trying to hide it. It is your responsibility to find out what those things are. Generally speaking, that due diligence period, it's very simple to find out those answers because you're going to run into the same people. If you're talking to the village or the city and you're saying, hey, what's the highest and best use of this? There's 3 other people that try to do this. Oh yeah, that guy's trying to sell that land. The problem with that land is there is X, and that's why this can't be done. And he's been marketing it the wrong way. So you immediately will find out by doing that due diligence. The other thing too is all the paperwork and all the closings and everything goes through attorneys or title companies, and all that stuff that's on record will come out. That's what clear title is about. So you still have a responsibility of knowing what the pluses. I talked to a guy the other day. He bought a piece of property for him and his brother. There was a 35-acre minimum on that. And this is another one. Had to have 35 acres to build a house in that area. The piece of property was 35. He built his house. The realtor assured him that, oh yeah, your brother and you can both build a house on this. He built his house on 5 acres, sold the 30 acres to his brother for $100,000. Now the municipality will not allow him to go because it's less than 35 acres. And he is ticked at the realtor. He goes, but it was my fault because I should have dug deeper before I did it. I told him, I go, the quick fix is try to buy a contiguous piece of land for 5 acres. And now you got your 35, you can roll. But if they can't get an extra 5 acres, there is no way they can build another home on that. And he's like, basically, I sold it to my brother for 100, which my brother got robbed. But in reality, I'm not gonna let my brother get robbed, so I'm gonna buy it back anyway. So I got robbed because I got to spend an extra 100. So he was ticked at the realtor because it was still his fault because he bought it.
That's it.
Awesome. Thanks for being here today. Man, we almost went a full hour. If you have any questions, you can reach out to me at 608-306-1199. We are raising money right now. We offer 5 points and 7%. It's a great conversation to have if you're interested in capital. Also, you can come and we're going to be doing these trainings on a lot of different topics. If you have a topic you want to just cover, it'd be awesome for you to just let us know. You can text me at that number. It's my live cell phone. So with that, have a wonderful weekend, and we will be doing our next training on Tuesday. I don't have a topic yet, but we will be sending out in the email. So have a great weekend. Thanks for being here.